Hello everyone. The jolt caused by last week's disappointing non-farm payrolls is but a distant memory now as investors rush into risk assets worldwide. Most stock markets were up yesterday after a lower than expected China CPI helped to dampen fears of a sudden monetary tightening in China. Bond markets were generally the losers, with the noticeable exceptions of Spain and Greece, where yields declined, another instance of risk-seeking investments. This kind of risk appetite is now dollar bearish, a change from earlier this year, as investors pile into emerging market stocks and bonds, which have been outperforming U.S. markets recently. The dollar is also being hurt by the increasing view that the Fed isn't likely to begin tightening anytime soon. For example, the option-implied probability of no hike in rates by the December meeting has risen to 45%, up from 43% a month ago. Carry trades in high-yielding EM currencies tend to perform well in such an environment, with the dollar as the funding currency. Overnight, markets were surprised by weaker-than-expected Chinese exports and much stronger-than-expected Chinese imports, which resulted in an unusual trade deficit for the country in March. However, the surprising figures are to some extent just a reversal of the anomalous data of the past 2 months. In any event, the strong imports were good news for the Australian dollar, as China is Australia's main export market. Aussie dollar broke out from 104.90 resistance following the data and looks to head towards the 105.50 horizontal trendline resistance that's proven resilient 4 times in the past 9 months. 104.90 may act as support now, with further support at 104.60. A breakout from 105.50 will call for further bullish positions, with resistance thereafter around 107 the figure. This is Marshall Giller, head of Global FX Strategy at IronFX, wishing you solid trading.